Everybody can feel that things have changed and are changing rapidly, especially after the COVID lockdowns. They have this sense that something is not the same as it used to be. The Fed is trying to fight inflation, yet it's not really working. It's coming down, the inflation rate. And really what it all has to do with, and it all comes down to, is the manipulation of money.
My bond is paying me 5 and it's costing me 3, like, hey man, that's a 2% spread. Like, I'm doing pretty good. Or if the S&P 500 is making me 8 or 10% and inflation's at 3 or 4, like, I'm doing pretty good.
Right, and if you're a consumer, go home and do the work and add up all your expenses and compare them to last year and the year before,
right,
and the year before that. It's a lot of work. It's easier just to listen to what the pundits tell you.
And then if we think about the dollar, we also have to think about it and measure it against other things. So if I'm looking at only in dollars, like my house is worth, was $380,000 a couple years ago. Now it's $480,000 for like a median U.S. home. But it went down in oil, barrels per oil, or it went down in ounces of gold, and it went down in Bitcoin terms as well. And if you think about it, again, back to the Balaji's point, measured in Bitcoin, we are seeing hyperinflation in the dollar.
Bitcoin is seen as a risk asset. We talked before about how we're kind of in a gambler's economy. Like we have a lot of people out there who just feel like they're getting behind and they're gambling to try to catch back up or get ahead and taking a lot of risk. And so Bitcoin is seen that way in a lot of ways, and as are the meme coins. And we see the meme coins take off, it's because people are just risking money. They're like, come on, I hope that I can catch up to this inflation.
All right, so James, welcome back to the show, by the way.
Thank you for having me.
Glad we can do this in person. I love doing it in person. So, for the audience, you're my partner. We have the Bitcoin Opportunity Fund. You're a hedge fund guy. You write the newsletter, The Informationist, which is amazing information on the macro space. But you're sort of known, or maybe in my mind, you talk a lot about like the debt doom loop that we're in. Sort of how not just the U.S. government and the Federal Reserve, but really all the nations and central banks of the world are sort of in this proverbial rock in the hard place that keeps getting closer and closer and closer, right? And so we're in this like debt doom loop. I want to frame that up. Yeah. And what does that mean? How does that progress? Like over what time frame? But then I want to bring it down into like more practical terms. So like if I'm a business owner, like what does that mean to me, right? If I'm trying to manage money for my family or like make sure I don't go broke, like what does that mean to me? So then like how do we think about measuring that, looking at cycles, and what do we do about that? So let's start up with frame up the debt doom loop for us.
Sure. Well, first of all, thank you for having me again, Mark. Always good to be here. I'm on vacation, and you have my son in the audience.
Yeah,
and
we got someone in the audience. All right.
But it's always good to have people on vacation in your hometown.
Yeah.
Right? So I know that coming from Vegas. But the debt doom loop. Well, I do talk about this a lot, and the reason is because everybody can feel that things have changed and are changing rapidly, especially after the COVID lockdowns, and they have this sense that something is not the same as it used to be, and you've seen the prices skyrocket, you've seen homes skyrocket in price and then get really illiquid, so they're not moving. Interest rates are up. The Fed is trying to fight inflation, yet it's not really working. It's coming down, the inflation rate, meaning prices are still going up, and it's confusing a lot of people. And really what it all has to do with, and it all comes down to, which you and I talk about extensively, is the manipulation of money. And that manipulation of money has been necessary because we've gotten ourselves in this situation where, and this is all developed central banks, like we're talking about, they've all gotten themselves in a situation where they're borrowing and borrowing and borrowing so much money that they wind up having to manipulate their interest rates and their currencies in order to keep up with that borrowing. And just before the show, you were talking about how debt is kind of stealing from the future. And I think about it much in a similar way. I think of it more of like it's borrowing from the future, and you can use it properly. And, so if you're an individual and you want to have a business, but you don't, you're kind of stuck in your job, you don't really have enough money. Maybe you want to start a restaurant, and it's going to cost you $100,000 to start it, but you only have $10,000 in the bank. And you're like, well, I can continue to work and grind away and keep putting money away, or I can use that $10,000 as leverage for a loan that I can then pull that money into the now, borrow it from a bank, and start the business right away. Start buying the materials I need, the cookware and the ovens and all, and hiring people, start paying salaries. And then you open up the restaurant and suddenly you're generating income right away. You're generating productivity. Well, that's borrowing from the future. And if you do it responsibly, restaurants are, I use this example because it's really easy for people to visualize, maybe not the best.
Yeah, don't do the restaurant.
Don't do the restaurant. But if you do it responsibly, that's great. You've built a business. You're producing. You're adding productivity into the national GDP, right? But we've gotten ourselves in a situation now, Mark, that the entire nation, all of the Western nations, the developed nations, they're all using debt ad nauseum to paper up inefficiencies, whether it's energy inefficiencies or it's just capital inefficiencies, and they're using that borrowing to close that gap. So, for instance, right now our federal government is borrowing just about $2 trillion a year. Meaning they're above and beyond what they have to borrow to pay down past debt. So we're running $2 trillion deficits at a time that we're not even in a recession. So the irresponsibility that's coming out of Washington is monumental. It's absolutely incredible, and it's mind-numbing for people like you and me who have been in business, running businesses, and you look at that, and it's not only is it irresponsible, it's putting us on a path that's irreversible. And so why is that? Well, because we're running these deficits at a time that we're not even officially in World War, arguable, but we're not in a hot conflict right now somewhere, and so we're borrowing those $2 trillion from who? So we just have to keep borrowing and borrowing and borrowing and add to that national debt. And so what happens? Well, we've seen the debt grow from just when we talk about the debt spiral. You and I talked about this almost 2 years ago on this.
Probably, yeah.
And I wrote a piece on it 2 years ago, August, about how we are entering a debt spiral where we just can't get out of it, and meaning the U.S. government. So what is that, to frame it up? Well, the debt spiral means that we have accumulated so much debt that it requires more debt to pay down that old debt and eventually to pay that interest on that debt. And we're there. So of those $2 trillion deficits we're running, $1 trillion that we're spending a year is on interest on our past debt. So we're bumping up against, when I wrote that piece, we had $31.4 trillion of debt. And now we're just below 35 trillion in just 2 years, and not even. And so we're now at the point where we're spending $1 trillion on interest alone on that debt. And we're spending so much money that we can't close that gap. So what do I mean by that? Well, if the U.S. government was a company on the New York Stock Exchange, which it's not, I understand, because we have the money printer, but just put that aside for a second. We would consider it a zombie company. And why is that? Well, if you look at the national debt and how much we spend, so the amount of money we take in each year in revenues, in fact, I can pull it up here. The CBO just updated their estimates for 2024.
Oh.
So, and their estimates are that we're going to take in $28.5 trillion in GDP. Okay, so that's the national productivity. And off of that, we have a tax base, as you well know, that is going to be $4.9 trillion estimate. Okay, so the U.S. government has $4.9 trillion of revenue. Of course, the government is not creating anything. They're just taking from our productivity, but they're on the other side of that. The flip side of that is they're spending $6.9 trillion, and there's your $2 trillion deficit, which is now 7% of GDP. That's a bad number. Okay, so why is it a zombie? Why would it be considered a zombie company? Well, the most important, to frame up how to think about those deficits, you have to think about all those expenses that you may be able to cut in order to fix it. But the issue here is that our mandatory expenses, which are Social Security, Medicare, Medicaid, add up to about $4.1 trillion. Now remember, these are not numbers from me. This is from the Congressional Budget Office that puts out this estimate every single year, and they do that kind of as a wake-up call to Congress and say, hey, this is we need to fix some of our policies here because we're on a bad path. But anyway, so we're spending $4.1 trillion. Remember, we're taking in 4.9. So you've got $800 trillion left. Well, our defense spending is $950 billion this year that we know of. It could be, there could have a lot of other expenses tucked in other places.
And to put that number in relation, not to cut you off, but the U.S. spends more on its military than the next 10 nations combined. So it's not just military spending.
Context.
It's like our military spending is more than the next 10 nations all put together. Yeah. So it's an astronomical number.
Right. So now you've got 4.1 plus 950. You're already over $5 trillion of spending. Then you've got the net interest, because the net interest on your debt, you've got your debt that's over $1 trillion of interest expenses. You get some back from intergovernment agencies. Let's call it $900 billion. Well, your total mandatory expenses now are over $6 trillion. And that doesn't even take into account the discretionary expenses. So your deficit's $2 trillion. So now you've got to borrow money. You have to issue more debt to pay down debt that's maturing because you don't have the money to pay it down. So you're borrowing more, which means that when you're running these deficits, Mark, this is inflationary. This is money that they're basically just printing and putting into the economy and continuing to grind the economy on a nominal basis. And so we're watching inflation just continue to rise. And so, and as that's occurring, the Fed is raising interest rates, which is making the interest payments on that past debt more expensive, which means that the government has to issue more debt, which means that they have to pay more interest on more debt. And so you get into what's called a debt spiral, and there's really no way out. It's like, if you're trying to meet your expenses, you're using credit cards, and sooner or later those credit cards max out because you're not making enough money. You're borrowing it, but you're paying interest on that. And then sooner or later you're going to have to take out another credit card just to pay the interest on the last credit card, and that's the debt spiral. And so we saw it happen with Greece and a number of other nations in the last 20 years, and that's where we're at.
So basically, the debt can't be paid down because of the situation that you framed up. Another reason why, though, is because of the nature of the monetary system in 1971, going from maybe arguably before 1971, but going from like an equity-based system, a gold system, to a debt-based system. So the debt also has to grow from that perspective as well. So we have sort of two reasons why it can't go down. We're spiraling out of control. The deficit, the amount of debt they're taking on, is growing at an alarming rate. I think it's about $1 trillion per quarter almost.
Yeah, at last check, it's about $1 trillion every 100 days.
Yeah. Which is just about a quarter. I mean, it's just an insane amount. And that is what's causing all this to happen. Okay, so that's the debt doom loop. Now, there's a lot of people who have been calling for this to all come to an end for a long time. Mm-hmm. Peter Schiff, Harry Dent's written a number of books about it. We can go on and on and on. But it seems like they never see, they fail to take into account how many more tricks up the sleeve that these central bankers can come up with. But at the same time, it does seem like the walls are closing in. The rock and the hard place is getting closer and closer together. How do you think about that? How do you project that out?
Well, you hear a lot of people, people say, well, why don't they just cut expenses? Right? Clearly, if we're spending too much, just stop spending so much. Well, you just heard, where are we going to cut?
In 2020, we were spending about 4.6, I think it was 4.6 trillion. So we've gone from 4.6 to almost 7 trillion in just a couple of years. And the world wasn't catastrophic in 2020. why couldn't we just go back to like spending in 2020?
Well, there's a number of reasons, but a lot of it has to do with when we had the lockdowns that pulled on a string that caused disruptions in a lot of areas that they didn't expect. And one of the areas that it caused disruption is, well, they printed so much money because there's so much to dig into in the treasury market, but just suffice to say that the treasury market it was dysfunctional. And so the whole reason we print money is to keep the treasury market going, right? So the Fed printed money, it expanded the M2, the money supply, that caused that, plus the problems with the supply chains caused inflation. And so that caused the need to adjust some of the benefits for retirees, Social Security. That's a whole nother problem that we can talk about. But Social Security, those benefits were adjusted higher from the cost of living at the same time that boomers were retiring en masse because they were like, you know what, I don't need to be in the workforce anymore. My house is worth so much money now. I've got these retirement benefits. I've got my pension. I've got the Social Security and Medicare, Medicaid. I'm set. I'm going to retire. So now they're paying out at a much higher rate than they expected. And so this has caused a massive gap in those in that line item. Yeah, exactly. So that line item jumped higher. So what do? If you heard what we said, the mandatory expenses signed into legislation or defense or interest on your debt. You're not going to default on your debt if you issue in your own currency. But where are they going to cut? So that's not really possible. And number one, there's really no incentive to do it. We can talk about Republicans or Democrats or which party's worse at spending. It doesn't matter. They're all in the same game. They spend to get reelected. It's just we hear Jeff Booth talk about it all the time. If you want to find where the problem is, look at the incentives. And the incentive is to get reelected. So if the incentive is to get reelected, the incentive is to then spend money, make sure you take care of your constituents. Those who are donating to your campaigns, make regulations good for those companies and those constituents, and then just work it around so you can get reelected. And that all points to spending more money. So we don't, like right now, Mark, we don't even have a debt ceiling. We paused it. There's no debt ceiling. So we could just keep spending, and Congress has no limit. And that's not going to come up again until January. So we can go right through this election just spending ad nauseum. So
in the last debt ceiling debate, Biden himself, when he was still able to talk somewhat coherently, had said, we have to raise the debt because the U.S. can't default. The U.S. has never defaulted, so we need to get more debt to pay the existing debt. I mean, he basically said it right there. Yeah. But it's not, I mean, it's certainly not a political thing. It's a math thing, right? And so it's like, we owe the money's got to be paid, so we got to print the money. Now, there's certainly a lot of pork, as we call it, right? That's certainly getting funded as well. But at the same time, it's a math problem that we're in. And unless the government wants to default, then this is the path that we're on. And so when I say default to the old people that are owed entitlements, right? Lou Grahman talks about, other nations, they can't print dollars, so they're in a tough problem. But the U.S. doesn't owe dollars either. The U.S. owes like medical services, for example, right? Although we do know that the homeless population, half of the population are now baby boomers. So we do know that those entitlements are being cut.
Well, they're not keeping up.
They're not keeping up for sure. And so those entitlements, those promises that were made to the VA, the veterans, and to those old people, they're not being met, which is why the homeless population is sort of being grown from that. Okay, so that sort of sums up the problem. Now, correct me if I'm wrong, but I mean, the U.S. is the cleanest shirt in the dirty laundry, so to speak. So we can basically take this sort of problem and extrapolate it to the rest of the world. I mean, Japan, the ECB, Europe, I mean, they're in worse situations than the U.S.
Yeah, I mean, well, going to what you said when Biden, the last time he was talking about the debt spiral, well, in just this last debate, he was talking about how, he's got a solution for fixing Social Security. And his solution is to raise taxes on the rich.
Always.
Right? Always.
They don't pay their fair share.
No, of course. But even if you raise taxes on the 71 trillionaires we have in the United States, or billionaires you have in the United States, you would get
that was like a Biden moment there.
Right.
So, 1,000 trillionaires,
a million trillionaires.
Yeah.
So, but if you raise taxes on our billionaires, the 71 of them that at last count, you would be able to tax what if you tax them 100%, you'd have $5 trillion. The problem is we have a Social Security hold that's $172 trillion. What's so important about that is that you're talking about unfunded liabilities on top of debt. We're talking about something that's approaching a quarter of quadrillion dollars, $250 trillion of owing. So debt and unfunded liabilities, things that we owe in the future. So taxes, I mean, that's clearly it's just not going to work to fix this hole. And also, as you well know, the more you tax, the less you incentivize productivity. So research and development, investing into productive product lines, hiring people, all of that. So you wind up getting higher taxes on lower productivity and actually declining productivity. So that's not good. So, but just to make it clear, the taxes aren't going to work either. So what do? You just issue more debt. But if you issue more debt, then the only way you can keep that going, that whole charade going, is by exporting your inflation on the world. So all we're doing is we are creating a situation where we have no choice but to have high inflation in order to have taxes on larger, excuse me, nominal GDP to pay down past debt. And so that's what we're doing. Excuse me. Okay. So
sounds pretty bleak, James. Sounds pretty bleak. So what I'd like to do is, people hear from me all the time, and so I kind of give my projection of what I think happens over the rest of this decade. But I'd like for you to kind of tell us what you think is the base case. Obviously, anything is possible, but let's talk in probabilities. What do you think is the most probable outcome over the next, what do we have, 6 years at this point? Then we're going to talk about like I said, if you're a business owner, like what does this mean for you? How do you think about that? And then I want to talk about the safety valve that we all have, which is Bitcoin and stuff that we see happening over there. But let's just talk about what is your sort of base case for how this continues for the rest of the decade?
Well, I mean, look, we've got a lot of uncertainty right now politically. So you're watching people try to figure out in the markets who's going to win, whether it's going to be Trump or it's going to be Biden.
But you said regardless of the political party, it's more of the same.
But you're watching Wall Street kind of position themselves. And the reality is that because of what we're talking about, because of the sheer amount of debt that we have, it's so great, and those liabilities are so great, that there is no choice but to have that inflation. And so you can think about it in this way. We were talking about it before the show, how the 60-40 portfolio is kind of dead. And the reason for that is that who wants to invest in a 30-year treasury that they know is going to be worth less on real terms, the money they get back from that 30-year treasury in 30 years than when they put in? Like, who wants to do that? You're going to have, so in the next 5, 6, 7, 8 years, I expect us to get into a period of very high inflation. We could see a downturn. We're starting to see now data that's showing that the economy is kind of rolling in a lot of areas. It's confusing because you've got the government spending so much money that we've created a situation where there's fiscal dominance. And so that fiscal dominance is the government is just spending and spending and spending like mad, and it's creating pockets of expansion at the same time that you've got pockets of contraction in private areas. So any business that is beholden to or is affected by interest rates, especially these high interest rates, they're starting to feel the pinch. The margins are compressing. They're having to pay more on debt when they go out to get a line of credit, or their line of credit resets and it's a higher rate. They're starting to have to pay more interest on that. You're not seeing as much hiring. And so the job numbers, the jobless claims, the unemployment is ticking up. And so you're seeing this economy. It looks like it's turning over, especially because we got numbers this morning in the services industry, really important part of the U.S. economy. And that feels like it's turning over. But we can't have that. We could have kind of a soft landing and continuation on. That will only happen if we keep spending money, we keep issuing debt, and we keep creating more inflation. But the reality is, if we get into a deep recession, we're going to have to print so much money, it's going to make your eyes bleed. And so how much did we print in 2020?
11 trillion.
Yeah. And the Fed bought 6 trillion of that. So really the Fed, we're going to have to print multiples of that this time because just of the sheer amount of debt. So why does that matter? Well, what matters is I see a period where whether or not it's blatantly obvious or they admit it, we're going to have high inflation. And the reason is that we have to keep printing money in order to make sure that the treasury market remains functional. We've heard Powell talk about it recently, not this last meeting, but the meeting before, where he was talking about where does he feel comfortable with bank reserves. And as bank reserves get down to 10% of GDP, well, then he starts getting nervous. And we're right about that level right now. Actually, bank reserves are up over 3 trillion. I apologize. That's not quite right. But we're getting towards that level. And when the reverse repo, where all the excess slosh is from all that money printing, where it's parked, when that's gone, then they're really watching that number. Because when that treasury market gets dysfunctional, then they're going to have to print money to make sure that it stays liquid. So we're seeing, okay, this all matters because the big picture is we're seeing little hints that they're getting ready or already injecting liquidity into the market. So you saw and the money supply, M2, has ticked back up in the last 6 or 8 weeks, right? Yeah. And so how is that happening? Well, the central banks are finding ways to get money into the system because they know that we can't have this hard landing because they don't want to print another 10, 20 trillion dollars. That would make inflation rip higher again. But what's the choice, right? So we're seeing things like ISDA, the International Swaps and Derivatives Association, come out with a letter that implored the central banks and other authorities here to get rid of the limit of treasuries and that banks can own, basically. What it said was remove them from the risk calculation. So they could own as many as they want, arguing that treasuries are riskless. We know
Right.
they're not riskless.
Yeah.
But, well, why would if they do that, well, that just creates the ability just to keep liquidity going into the system. You don't have to have those checks and balances of just how much liquidity the banks have available for their capital base, right? So that's one thing. And then you're watching Janet Yellen do something called this regular treasury buyback. Is it really QE, quantitative easing? No, but they're buying off the run treasuries that are not as liquid just to make sure that there's more liquidity, So there's more liquidity. There's hints of more liquidity, more. So I expect this to continue and possibly accelerate, especially as we see, some commercial real estate. Not all commercial real estate is bad, but there are pockets of difficult spots. And we're going to see some bank rescues or whatnot in the next 6 to 9 months.
Which means more liquidity.
More liquidity. It all points to what? More inflation, which goes back to your point of, okay, what can individuals do and what can entrepreneurs do to make sure that they're on the right side of this, right? So, and that's really the big question. And so for me, I'm seeing that if you're an investor and you're investing in bonds, well, I mean, God help you. I mean, like, there may be a trade, but I would not be investing in bonds long term, personally. And if on the flip side, if you're an entrepreneur, and you're borrowing, if you can borrow at a rate that's fixed and that meets your requirement for your capital requirement, then that's an intelligent thing to do for me. But what I wouldn't do is I wouldn't be beholden to rates that could adjust much higher, because that, to me, in the near future, could be a problem.
So to kind of recite this and sort of recap it back, because of the debt-based monetary system and the debt doom loop that we have that you set up in the beginning, the system has to continue. As long as the government wants to continue to pay the things that they're obligated to pay, then they're going to have to continue to borrow and continue to print money.
And why wouldn't they, right?
Of course. Well, theoretically, philosophically, why would you default when you can print money? Right. So there's number one. Number two, more empirically, we can see that pretty much every nation right now today in the world does that. So, Lebanon, Turkey, Venezuela, Argentina, Peru, I mean, you go down the list. They're all printing and using debt to offset this. So there is no historical context for a nation just going, well, it was a good run, boys. Let's fold up shop. Like, there's just no historical context. So we see it happening in real time all around the world, where this is exactly what they do. And you just print until you can't print anymore. And I didn't want to kind of go, I'm not going to go through my whole thesis, but, I just think things end more in a whimper than a bang. Everybody's thinking that there's going to be this final days where the system is going to crash and the dollar is going to die and the Fed loses.
I hope not.
But it's a whimper. And we know that just because that's what Zimbabwe does. And they obviously inflate a lot faster than other countries, but it's a whimper, not a bang. And so I think it continues. So that's sort of my base case as well. Now, you sort of use like an Austrian economics kind of term on inflation, it sounds like, because you're talking about more inflation ahead in terms of money printing and not really consumer prices. And maybe you're using those interchangeably. I recently talked about on a different video how Ludwig von Mises in 1950 gave a talk of how they were changing the definition of the word inflation from monetary inflation to prices. And in 1950, he called them out on this, and he said, the reason why is because then they can lie to you and hide the true inflation, which is the money supply increasing. And so you sort of set up why the money supply would increase and say there's more inflation. There's more price inflation for a lot of other things, like having to re-onshore, nearshore, less global cooperation, things like that. Okay, so but I want to hit on that monetary inflation for a minute, because you talked about why bonds are bad, you wouldn't buy them, or why entrepreneurs or business owners should think about fixing in debt. So if we think about, and this is where I think most people are completely caught off sides by this. So they're looking at the government given numbers, the CPI, consumer price inflation, which is a false number for any number of reasons we can talk about. But that number today is in the threes.
Yeah, highly manipulated.
Of course, right? Yeah. So if, my bond is paying me 5 and it's costing me 3, like, hey man, that's a 2% spread. Like, I'm doing pretty good. Or if the S&P 500 is making me 8 or 10% and inflation's at 3 or 4, like, I'm doing pretty good.
Right, and if you're a consumer, go home and do the work and add up all your expenses and compare them to last year and the year before,
right,
and the year before that. It's a lot of work. It's easier just to listen to what the pundits tell you.
Right. But so the problem why I think most people are caught off sides by this is they see their paycheck going into this index fund and the S&P 500 is going up at 9-10% or whatever it is. And like I said, inflation's at 3-4%. Like, hey, I'm doing pretty good. To your point, if they would do the math, they'd find out it's not. But back to sort of that monetary, or that Austrian view of monetary inflation, which is the money supply increasing, the debasement rate. And so the money supply since 2019 through 2023 has been increasing in the U.S. by 10%. So that's what we call the hurdle rate. So
since 71, it's about 7.1% on average. Like,
yeah.
So.
But if you look at a chart of M2 or Fed balance sheet or whatever, you can see that the trend line keeps getting steeper. I think, I don't want to go into it. You and I have talked about it, but really pretty much most of the financial data pre-2008 doesn't, you have to look at it with an asterisk. We're in a different environment that we are in today, so that trend line has changed. So since 2019, we're at about 10%. So we have the monetary supply, the rate of debasement is moving up 10%, plus we have the inflation, plus we probably have to adjust for risk. So I don't know, does that bring the hurdle rate up to 12 or 15%?
Could be.
And so then we get 4 or 5% on bonds. And how are you going to get 4 or 5% on bonds when we have this 10, 12% hurdle rate?
Right. Or you buy a bond that's yielding 4.5% now. And yeah, you might get a trade here between now and the time that the Fed lowers rates, and make a couple percent off of that. Meaning you could make, multiples of that. But the problem is, if we get into a downturn and that money supply is expanded, like you said, that structural change happened when we printed for the first time. So if you go back, it was really 1987 that when that crash, I was in high school, but that the Black Monday occurred, and Greenspan came out and said, "Don't worry, Wall Street, we've got your backs. We're not going to let you collapse. We're not going to let the banks collapse. We're going to make sure that the market is okay." And that was just a signal to them, but they didn't really do anything. Flash forward to 1998, just 11 years later, and you had the long-term capital management debacle. This is a firm that was a hedge fund that was run by 2 Nobel laureates, and they were these geniuses. And there's a book called "When Genius Failed," great book by Lowenstein about what happened there. But what occurred was, these guys had so much leverage. They had $1 billion of investment of AUM in their hedge fund, and they had about $100 billion that we know of in trades. So they were at least levered 100 to 1 on these spreads that they were basically shorting volatility the way they were doing interest rate arbitrage. But they had those trades levered way up. Well, the street got wind of it, and you know what happens when the sharks smell the blood. Yeah. Then they blew up these trades on them. So this fund was going to collapse, long-term capital management. And so, but Goldman had massive exposure to them. So Goldman Sachs CEO went into the New York Fed and begged. They're like, "Hey, we're going to collapse tomorrow unless you rescue us." And so they didn't print money the first time. The second time, the New York Fed led a bailout with the other banks for Goldman Sachs, basically made sure that they shored up their balance sheet. And so they didn't print money, but they assured that there was no way they were going to collapse, right? Then you had the tech bubble, and that kind of that deflated a lot of things. It was a little bit healthy, and then you had the housing crisis. So now you flash forward to 1998. From 1998 to 2008, 10 more years. So you see a pattern here, right? 10 more years, 2008, and we have the housing crisis. Well, the housing crisis, then when that happened, it was so great, and there was so much contagion with those banks that the Fed felt like they had no choice, and all the central banks. And so what did they do? They printed all that money, and which back then, $1 trillion. And so they printed that money, and I don't remember exactly what the figure is, so we may have to yank that from the show, so we don't. I don't want to give people the wrong information, but they printed that money, and that's the first time they really printed money, 2008, which is what you're talking about. QE. The QE, and that's where the structure changed, right? So the structure changed when, the Fed put is here, they're going to save us. And there are no consequences. CEOs got their bonuses and payouts. Nobody went under. Well, they let a few go under. They let Lehman go under and Bear Stearns go under, but it wasn't the en masse slaughter of banks that should have been. And so we created an expectation from the market that the Fed will be there. Flash forward from 2008 to 2020. And you've got the lockdowns, and you've got the danger of collapsing. Again, banks collapsing and treasury market freezing up. And what do? They print again in multiples of the last time they printed. And so that's kind of where we're at. And that's what you're talking about, where that changeover. Yep. And now what do we do? Because we're so indebted. And this isn't just the sovereigns. This goes from sovereigns to the banks, to the companies and corporations, down to the individuals and consumers. Everybody's got, not everybody, but by and large, the average of indebtedness is at all-time highs.
Yeah. So back to the hurdle rate. So people see their S&P 500 going up by 8-9%, but they're losing money. So they have to kind of understand this monetary inflation piece, and that's kind of one reason why I think it's important to focus on that. And that's the real number that you're trying to beat. And there's not a lot of places that you can do that today. I'm not sure if you know, I don't want to put you on the spot, but like the definition of hyperinflation is, I think, 50% inflation month over month.
Month over month, yeah.
Right.
It's an economic.
That's the
definition.
technical definition. I did an interview with Parker Lewis. It's on the channel. Did really good. He said that's the technical definition. He said I would say that hyperinflation is when you can really see the price changes in real time. Mm-hmm. It's not like when I was a kid, this bottle of water was 5 cents. It's like, no, last year this bottle was, right. So he talks about it more like that, not a hard definition. I'm just curious if you know, because I don't. 50% inflation month over month compared to what? So like if I'm in Argentina in hyperinflation, so my currency is inflating, the Argentine peso is inflating 50% to the dollar?
No, it's their inflation rate. It's inflation of
so
their goods.
Whatever their own CPI calculation?
Exactly.
Okay. So the U.S. could never have high inflation as long as the U.S. doesn't report high inflation. That's what you're saying. The reason why I asked that is because I saw Balaji and another one of my good friends, Brent Johnson, Mr. Dollar Milkshake, kind of going back and forth on Twitter. And, of course, Brent is the dollar bull. He's much more reasonable if you talk to him in person. But, Balaji said, well, the U.S. dollar has been in hyperinflation measured in Bitcoin.
Yeah. That's absolutely fair.
And that's why I was curious, measured against what. And so the key piece I wanted to kind of transition into is that we have to understand that we have to measure these things in different ways, or otherwise we don't have a real number. So if you think you're making 5% on the treasuries, and that's good because inflation's 3%, or you think you're making 8% in the index, which is good because inflation's 3%, the true number is much higher. It's 10, 12% at least. So you have to think about how you're measuring these things. And then if we think about the dollar, we also have to think about it and measure it against other things. So if I'm looking at only in dollars, like my house is worth, was $380,000 a couple of years ago. Now it's $480,000 for like a median U.S. home. But it went down in oil, barrels per oil, or it went down in ounces of gold, and it went down in Bitcoin terms as well. And if you think about it, again, back to the Balaji's point, measured in Bitcoin, we are seeing hyperinflation in the dollar.
Yeah, because Bitcoin is something that has a very, very, very low inflation rate, and it's approaching zero. And so the half-life of it, of the Bitcoin inflation. But just like you said, it's a great way to measure just how quickly the dollar is expanding. And if you look at Bitcoin, it does follow the expansion of the money supply pretty well. I mean, it's definitely volatile, but the overall trajectory is very similar. And so,
per Michael Howell, who's Mr. Global Liquidity, I had him on the show a few weeks ago, so you should go check out that interview. Yeah. But he says that the S&P 500 is 90% correlated to the S&P 500, and Bitcoin is about 80% correlated. So it has an 8.95 times sensitivity ratio. So for every 10% increase in global liquidity, Bitcoin goes up by 90%. Gold has a 1.5 times sensitivity. So every 10% rise in global liquidity, gold goes up by about 15%.
Right. Well, but that also has to do with the fact that Bitcoin's in the middle of its adoption phase, right? So that's also occurring.
So what does that mean? That the sensitivity ratio goes down as Bitcoin gets bigger?
That I would expect that the beta to risk assets would come down for sure.
Okay. So I agree with that, right? So as the asset gets bigger, as the daily volume gets more, it's harder for the price swings to move up and down. So when there's, $10 of trading volume per day and I buy $8 worth, I move the market. When there's 100 billion, or what do we have, hundreds of billions of dollars of trading volume today, it's very hard to move the market. When it's trillions of dollars per day, it's impossible, right? So It's kind of like that. So
exactly.
But it's also the downside is dampened, but the upside is dampened as well. So the sensitivity is just dropping. I did this video and I was talking about ways to project Bitcoin's future valuation. And, you know, most of your old brothers on Wall Street can't seem to value Bitcoin because, you know, there's no intrinsic value, there's no cash flows, blah, blah, blah. And I said, well, there's three ways that we could do it. So number one, we use like Jurrien Timmer from Fidelity. He uses like Metcalfe's law to sort of measure it. The second way we can do it is like a venture capital firm would do it. So what are the markets we're disrupting? If we pull X amount of, 5% from each of those markets, how much would it be worth? And the third way would be based off of inflation. So if we look at Bitcoin moving on liquidity on a sensitivity ratio of like a 9 times sensitivity ratio, then to you referenced earlier, like the CBO is projecting how much they're going to print. So we sort of have an idea, which I'm guessing is undershooting the target, but we have an idea of how much global liquidity is going to increase. And we can look at sort of this way Bitcoin moves to that increase of liquidity today. Do you think that would be a good way to sort of measure it?
As a starting point, for sure. But then you also have to think about the fact that most people don't really truly understand what Bitcoin is yet. We're in our little bubble and we understand it. We talked with people who understand it inherently. And the issue here is that, there's a lot of different ways you can measure how many assets are in the world. But let's just pretend that today there's $700 trillion of investable assets. Well, Bitcoin at this point is a fraction of that. It's
1/700th.
Exactly.
Right.
So so it's not even 1% and of that. So why is that important? It's important because right now, as you said, Bitcoin is seen as a risk asset. We talked before about how we're kind of in a gambler's economy. Like we have a lot of people out there who just feel like they're getting behind and they're gambling to try to catch back up or get ahead and taking a lot of risk. And so Bitcoin is seen that way in a lot of ways, and as are the meme coins. And when you see the meme coins take off, it's because people are just risking money. They're like, come on, I hope that I can catch up to this inflation. And so with the broadening and deepening understanding of Bitcoin, especially because now that we have the ETFs and you're seeing institutions dip into it. They're dipping their toe in and they're starting to understand it. When institutions really do understand it and understand how Bitcoin is different than every other of those, the digital currencies, they'll understand how it can be a true store of value, how it's digital gold 2 or 3.0 for so many reasons. The immutability, the transferability, the ease to create commerce with it, to move it. You can move $1 trillion of Bitcoin in 10 minutes, basically. So, right. But once they understand that and they get to that true understanding of how Bitcoin is different, then they'll begin to not just allocate to it in their investments as a risk asset, but they're going to allocate to it as a risk-off asset. Like they'll start taking money, not just from stock portfolios, but from bond portfolios and saying, why am I investing in this long-term treasury bond fund or vehicle when I should be protecting my capital with this thing that's called Bitcoin that will rise in price exponentially as a dollar falls in value exponentially? Why wouldn't I make that investment instead of hoping that I get a real rate of return, which is your hurdle rate again, right, that beats that rate of inflation or that expansion of the money supply? And so the question is, what is that hurdle rate? Expansive money supply, if you could argue that that's really what it is. And then Bitcoin, the price will match both that expansion of the money supply and that adoption as a way to protect that money supply. And so you or me, we have a lot more of our personal liquidity tied up with Bitcoin, protected by Bitcoin. Whereas
saved in Bitcoin,
yeah. Where there's a lot of investors out there who have way more money than you and me that haven't even thought about it. And so the way that Bitcoin price moves is not really directly correlated to just the amount of money comes in. It has to do with the liquidity too. And so there's friction getting in and out of this asset right now. And so it's going to get to a point where it doesn't have that friction. And that means it's going to expand quite a bit more in price and asset value, which to me would be approaching the asset value of gold. And that's where you're getting, then you're getting a
12,
lot
13 trillion.
Yeah.
So 12 or 13
or
X
even
from
more
here.
now. Yeah.
Yeah.
So.
Yeah. Okay. Yeah. So people haven't caught on yet. They seem to be kind of coming on one. And, you know, once everybody agrees with you, then the alpha's gone. So the idea is to obviously get in before everybody agrees with you on that standpoint. So then to kind of recap this whole conversation, the debt doom loop tells us, the debt-based monetary system tells us, and the debt doom loop tells us that the monetary system has to continue to expand. Unless the government says, like I said, pack it up, it was a good run, let's shut it down. Otherwise, it continues to expand. So that's almost all but certain. There's no certainties in life, but it's almost all but certain. We know that as they print money, it's debasing. So prices are going up as the rate of money is going, or the value of the money is going down. But not all assets go up at the same rate. Some go up faster than others. And so the S&P 500 is basically keeping up with it. And some assets like gold go up a little bit faster, and some assets like Bitcoin go up way faster. So Bitcoin is benefiting, and Jerry Timmer from Fidelity makes this case. Not only is it the network effects, but also the scarcity and the inflation that are all three driving those. And so we know scarce assets move up much faster. So then I guess what you're saying, if I'm paraphrasing, is then Bitcoin is sort of like this life raft that you could go to protect yourself from the incoming tide of the money printing liquidity that's coming into the system?
I certainly see it that way.
Yeah.
And I believe that that more and more people as they gain understanding are going to as well. And so, I feel like I got into understanding Bitcoin late. Having just discovered it in 2020, after my son actually had said, "Hey, Dad, you should look at these digital currencies. There's something here." And so, being an old Wall Street guy, I ignored it, just like virtually every single one of my peers had done and continues to do. And so they're slowly coming around saying, is this something we ought to be checking out? And they're still doing it from that perspective of, hey, is there a lot of money to be made here? Instead of, hey, is this a place where we can safeguard our capital? It's a different mentality. It's going to take a while to get there. But I believe so. And there's a whole lot more capital that's going to come into the protocol, which means that it will be worth a lot more, in my opinion, in the future.
Yeah. One thing I've done is I talk about, but I've shifted my mentality, and I don't think about investing my money. I think about saving my money. So mostly Bitcoin, mostly real estate, and I don't invest in real estate or invest in Bitcoin. I save my money into those places. I'll do some speculative bets here and there and some early round companies a little bit. That might be investing or speculating, whatever you want to call it. But yeah, real estate, Bitcoin, that's where I save it. So James, you're the one of the managing partners of the Bitcoin Opportunity Fund, and you've sort of taken this Wall Street knowledge and history and brought it into the Bitcoin Opportunity Fund, which is closed right now, might be opening up again here in the near future. Tell us about what else you're working on and what people could be paying attention to that you're working on.
Yeah. So, and you're a partner in the Bitcoin Opportunity Fund, and that to us, David Foley and I are doing the day-to-day, being the institutional investors for a long time. We see this as a way to not just help make money for investors and generate profits for them, but to help grow the ecosystem. And the Bitcoin ecosystem, you think about Bitcoin, it's just that base layer. There's so many other things that are going on in Bitcoin, and the opportunities are in our mind are tremendous, and we're super excited about every single day. We wake up and say, what are we looking at? Like, how are we thinking about how we frame? And we're inundated with opportunities. And so, but the best thing about it is that we've got our hurdle rate, which is, hey, what's the risk reward of this opportunity versus what the risk reward of Bitcoin is? And that's where we see everything. Yeah. And so being on the Bitcoin standard for us makes it very simple for us to look at things that way. And so that's
a much higher bar.
Yeah, very high bar. And I write the Informationist newsletter, which I put out every single week. And it just takes one complex topic, financial topic, and simplifies it for people. And we talk about things like the treasury auctions, the Fed, inflation, how to look at inflation, how to understand it, how to understand the debt problem, how to understand the treasury problem, what's going on with Social Security, those things. Just making it simple and for anybody. And we have, like we were talking about, we have I have doctors, lawyers, firemen, nurses. We've got chemical engineers. We've got aeronautical engineers. We've got all kinds of people in there that they're intelligent people, but just may not have that experience and that knowledge that they should have been taught in school, but they aren't. And so that's what I'm trying to do, is trying to give them that knowledge so they are armed with that to understand what to do in their own investing and their own portfolios. So.
Yeah. All right, cool. Well, we're going to wrap it up. I'm going to go ahead and we'll link to the Informationist in the show notes. Awesome. We'll link to the Bitcoin Opportunity Fund. It's closed right now, but put your name in the pot because we're going to open up second fund number 2 here pretty quickly. Any closing words?
No, that's it. Good to be here, and I'm looking forward to go hanging out in San Clemente Beach.
All right, thanks, James.